Convert your 401k during downturns. In this episode, I'm going to address what to do with a 401k during a recession. Get ready, it's not what you think. So my name's Doug Andrew, and I've been a financial strategist and a retirement planning specialist now for more than 47 years, helping people prepare for a comfortable retirement. Most people save in traditional accounts like IRAs and 401ks, and frankly, I think many of them get duped into putting pre-tax contributions into 401ks or tax-deductible contributions to IRAs, thinking they're going to be in a lower tax bracket when they retire. Folks, I have seen thousands of people come to me with their yet to be taxed IRAs and 401ks, and if they accumulated any type of a respectable retirement nest egg, they're not going to be in a lower tax bracket. The only people that are in lower tax brackets are those that didn't save very much. So if you're serious about making sure you maintain the same lifestyle during retirement, or even a better lifestyle, and not outliving your money, hopefully you're saving more like 10 to 20% of your income or even more. But sometimes people say, well, I'm contributing 6% to my employer's 401k. They're matching 50 cents on the dollar. Isn't that enough? Probably not, unless you're going to be saving for 40, 45 years. So you ought to be socking away 15, 20, 25% of your income. Learn to live on less than what you earn and sock it away. Now, my favorite vehicle for retirement savings is not in a tax-deferred account. Because when you think about it, if you're not going to be in a lower tax bracket, why do you want to defer tax to some future perceived unknown advantage and then withdraw your money later when most people are convinced taxes in the future will likely be higher? So let me explain why and then show you what you should do during a downturn in the market or a recession to get your money out of those 401ks. So to use a simple metaphor that I've used for years, if you were a farmer and you had the choice of buying your seed in the springtime, and when you bought your seed, you didn't have to pay tax on the price of the seed. You plant it, you irrigate, you cultivate, you work hard, and in the fall, you're gonna harvest your crop, and now you agree to pay tax on what you sell your harvest for. That's a traditional IRA or 401k. It's based on the premise that you will likely be in a lower bracket when you retire, because that used to be true 30, 35 years ago. That's no longer true. Most Americans, they pay off their house. They don't have that deduction anymore, the interest deduction. Their kids are gone, or if they move back in as adult children, you can't deduct them anymore. If you're a business owner, you don't have those deductions anymore. You're not contributing money to IRAs and 401ks in retirement. You don't have those deductions anymore. And Congress keeps raising taxes. So most Americans, when I ask, how many of you think taxes in the future will likely be lower? I get nothing but crickets. How many think they're going to be the same? A few hands go up, but when I ask, how many of you think that taxes in the future will likely be higher? A sea of hands goes up. And then I go, so why are you postponing, deferring, procrastinating paying tax to some future perceived unknown advantage to withdraw your money down the road when taxes are higher? And they go, yeah, that doesn't make sense. So are you talking about a Roth? Well, a Roth IRA or 401k is a step in the right direction, but there's still too many strings attached. So I've never owned an IRA or 401k. I never will. I've never owned a Roth IRA or 401k, and I never will. My favorite vehicle is called the Laser Fund. It has the two benefits of a Roth and 4 additional benefits that Roths will never have. So why would I waste my time with a Roth IRA or 401k? Now, if you're sitting here right now watching this episode and you have money in a 401k, there are times that you ought to seize opportunities to get the money out, get the taxes over and done with, especially if you're over the age of 59 and a half. But sometimes under the age of 59 and a half, you might incur a 10% penalty, but that penalty on top of the tax might be less at certain times than if you wait and postpone until you don't have the 10% penalty anymore. There is a friend of mine, Richard Rossi, that says, when there's anxiety, there's opportunity. When there's anxiety in the market, when we have a recession or a market crash, that is an opportune time to analyze if you ought to roll money out of a 401k or an IRA and get the taxes over and done with sooner than later and reposition the net after-tax money into something that's going to be tax-free from now on. And I prefer one that will reimburse you for any taxes that you incurred during the rollout process. So this is called a strategic rollout, not a rollover. A rollover is like going from the frying pan into the fire, as far as I'm concerned. That's rolling money over from a 401k into an IRA. You're continuing to delay the inevitable, okay? That does not save you tax. I can prove that to you mathematically. So when we have a downturn in the market and people ask, what should I do with my 401k in a recession? You want to look at getting money out of that 401k strategically to pay taxes on the values when they're lower. Would you rather pay taxes when your account values are high? You'll pay more in tax. Or when they're low. And then recapture the gain in the market safely, tax-free, instead of waiting around until you retire and then having to pay tax at a higher rate. Is this making sense? So let me take you to sort of an illustration to help you understand where most Americans accumulate their money for retirement. Some have money in all four of these buckets. Some only use one or two. But I'm going to show you the difference and what my favorite strategy is to provide tax-free income that will last as long as you do. So here we go. When we talk about retirement accumulation vehicles or buckets, there are generally four areas that most Americans draw from during retirement. Now, a lot of people don't draw from all four, but we'll cover these. The first one is the most common, and that's where most Americans accumulate money in tax-deferred IRAs and 401ks, thinking they're going to be in a lower tax bracket when they retire, and then they have this wake-up call, and all of a sudden they're paying taxes through the nose. Do you know that most American school teachers, for example, they will pay back every dime they save in taxes over 30, 35 years on the contribution phase, on the seed phase, during the first 2.5, 3 years of retirement, during the harvest phase. And they pay it back again and again and again. By the time they pass away in their 80s or 90s, most retirees have paid back 8 to 12 to 15 times the taxes that they saved over 35 years on the seed money, on the contributions. Whose retirement were you planning anyway? Yours or Uncle Sam's? So a lot of times people, when they would come to me as a retirement planning specialist, because I've done this for 47 years, I would look at their statements and I would actually ask them to bring their after-tax IRA and 401k statements. And they go, after-tax statements? I don't think we have those. I knew they didn't have them. And so I say, well, I'll calculate it for you. And they're shocked because they think they have $1 million in their IRAs or 401ks. And I go, that's not all your money. About 300,000 of that belongs to Uncle Sam, because the government has a permanent tax lien on those IRAs and 401ks. That's been the bargain all along. So it's amazing how many people are way too top heavy in this bucket. They have most of their retirement resources and yet to be taxed IRAs or 401ks in the market. And I go, did you know Wall Street was never built or intended to create predictable cash flow? If you ask Wall Street, when is the best time to sell my stocks? They will always say, never, never, okay? You have to change your strategy. So this necessitates a strategy, what I call a strategic rollout. Now, some people accumulate money in real estate. That's okay. I don't like to be a landlord. And so a lot of people, they have acquired properties, they get rental income. But I would recommend no more than 30% of your income come from real estate. And truth be known, a lot of people are sick and tired of fixing toilets, evicting tenants, taking out the trash, but they don't want to sell because they'll have to pay a capital gain. It looks like under the Biden administration, capital gain taxes are going to double to ordinary income tax rates, up to 40% or so, and they're going to do away with the step-up in basis on long-term capital gains. So this may not be so attractive anymore, and I've helped a lot of people sell their real estate, pay the capital gain tax at today's lower rates, for example, rather than waiting until they go up to ordinary income tax rates, and reposition the net after-tax money into my favorite vehicle, the tax-free bucket. Okay, I'll show you that in just a moment. I would recommend that no more than 30% of your retirement income be in this purple bucket when you retire. at retirement planning is something totally different than maybe what you did for your retirement. Now, some people like the guaranteed bucket. This would be Social Security, pensions if you're a school teacher, a police officer, fireman, or whatever. You have a pension, you have Social Security. Some people will buy an annuity that will give them a guaranteed income. They don't care about being rich. They just want to be guaranteed they will never be poor. And so it may not be a very good rate of return, but they will buy an annuity. Now, I've never owned an annuity. I doubt I ever will, because I know I can outperform an annuity with the green bucket, okay? This is the tax-free bucket. It could include Roth IRAs or 401ks, but I've never owned one of them because frankly, I can do better with a laser fund. I have 6 benefits instead of just 2. Municipal bonds are not near as attractive as they used to be. They're low yielding, and a lot of municipalities are filing bankruptcy. They're not as solid as they used to be. An MFTA, max funded tax advantage insurance contract, structured correctly and funded properly, qualifies to be called what I call a laser fund. Laser is an acronym that stands for Liquid Assets Safely Earning Returns. It is the only vehicle in the Internal Revenue Code that I'm aware of that allows you to accumulate your money tax-free. Under Section 72E of the Internal Revenue Code, it's been that way as a sacred tax-free cash cow for over 107 years. It allows you to access your money tax-free under Section 7702, and when you ultimately die, whatever is left in there blossoms, increases in value, and transfers totally income tax-free. I'm 69. If I died tomorrow in an accident, every million I would have in my green bucket would blossom to about 2.5 million and transfer tax-free to my heirs. There's not a Roth around that will do that. People say, how much does that cost? Well, nothing's free, but it doesn't cost me anything. It's being paid for with a minuscule portion of money that would otherwise go out the window in unnecessary tax if I kept my money in a purple bucket. I can prove that all day long. So when we look at all of these, I would recommend 40 to 60% of your income be totally tax-free, not even show up on your 1040 tax return. When people would come to me and they'd have $200,000 of income, maybe $40,000 came from Social Security or their teacher pension, $160,000 was going to come out of here. And they would, be so proud of themselves. And I'd go, way to go. You saved $2 or $3 million to be able to create $200,000 a year of income. But there's one problem. It's all showing up on your 1040 tax return. They would go, you mean there's another way? I go, yeah. They would go, where have you been? I said, I've been here all along. You've had your head in the sand following the herd, blinders on, just following the herd, putting money in traditional IRAs or 401ks, and now you're in a tax trap. I need to free you. In 5 years, performing what I call a strategic rollout, we would get, let's say, 120,000 of that income moved from here down to here. They still have the same 200,000 income, but only 80,000 is showing up on their 1040 tax return. The other 120,000, the IRS knows they're receiving it, but it's tax-free. It's very cut and dried. I save them over 30,000 a year of tax. If they live 20, 25 years, I save them $800,000 of unnecessary tax by performing a rollout from the purple bucket with maybe 60% of their money down to the green bucket. It's not that complicated, but most financial advisors don't know how to do this. So how can you learn more about this strategy and what to do with your 401k during a recession? So in order to learn more about this, I would recommend that you subscribe to this channel. Why? Because I have over 500 educational videos like this. And you can search. If you subscribe, be sure and click the bell so you'll be notified every time I post a new video, which I do at least 5 times a week. And share this, post a comment, click like. But let me show you how you can learn more by receiving a free gift. Now, I've been doing this for 47 years. I've written 12 books. This book, number 11, has been flying off of our warehouse shelves. It's called The Laser Fund, and it's how to diversify and create the foundation for a tax-free retirement. It shows you how to do a strategic rollout and put more of your money into the tax-free bucket. The IRS will know you're receiving it, but they know it's tax-free because it's been cut and dried in the Internal Revenue Code that way for over a century. So you can claim your free copy by going to laserfund, laserfund.com, or click on the link below. Contribute a nominal amount towards the shipping and handling. And it's actually 2 books in one. This white covered side is 200 pages, 14 chapters, with all the charts and graphs, and we talk about strategic rollouts in here and these 4 buckets. When you flip the book over, you can read 62 actual client stories, and there's one entire chapter with 5 or 6 explanations of clients who have done strategic rollouts, and we saved a school teacher couple $250,000 of unnecessary tax. We saved a real estate investment guru $750,000. We saved a husband and wife, both were physicians, $1.2 million of unnecessary tax doing a strategic rollout. We took one California couple from the highest tax bracket in 5 years down to a 0% tax bracket. Their $4 million doubled to $8 million, and that $8 million is generating $600,000 to $800,000 a year of growth, totally tax-free. They don't even need that much money. Claim your free copy, and there's options there to listen and learn, watch and learn. Here is to your brighter future.